Coming up, Riverside, big profits in small multifamily, Airbnb versus long-term rentals, seller blinders, and small margins for error. Be sure to stay to the end of this one for a hot tip on the best charcuterie and wine bar in San Marco. But first, a tasty musical treat from one of Jacksonville's very own. Hello, Jacksonvillians. I'm your host, Ian Brown. This is the Jacksonville Commercial Real Estate Show. We bring you dynamic entrepreneurs, deal makers, and local thought leaders ready to dive in and unpack our Jacksonville commercial market so you can navigate with greater confidence and accelerate your own success. This show is lovingly produced by yours truly and Yield Coach Capital. Stay up to date and never miss an investment opportunity. Go to www.investwiththecoach.com, answer a couple of questions, and join the team. I am honored to be joined by Mr. Stephen McAdoo today. He is the Director of Multifamily Sales at Franklin Street. Stephen, welcome to the show.
Thanks for having me, Ian. Happy to be here. Honored to be here.
Awesome. We've got a burning question for you. Can investors still make money in Jacksonville multifamily in this fourth quarter of 2023?
That's a great question. I absolutely think they can, but the game has definitely changed in how people are approaching deals right now in this market. I think that you've got to be more aggressive now. The people that are on that list, if they stay consistent, they stay looking for deals, keep making offers, keep giving feedback, then those investors are going to be rewarded.
Mm-hmm. I think the days of just going to a weekend boot camp, getting an underwriting spreadsheet, putting out some clever social media posts, raising money, getting a loan, buying an apartment complex, I think those days are somewhat behind us. I think I saw a stat, transaction volume, not prices, transaction volume is down almost 80%. And that could be a larger geography. What I'm wondering is, you're the Director of Multifamily Investment Sales over at Franklin Street. How are people adapting their underwriting? Here we are as we record, we're deep in the fourth quarter, 2023. And you have a specialty, in my opinion, in, these small to mid-size multifamily deals. You operate in good neighborhoods in Jacksonville. I've seen you obviously transact in your Riverside and San Marco and places like this. And are people in those smaller assets, 5 to 50, definitely under 100 units, the changing market conditions, are they affecting those investors the same, or is it more nuanced with your smaller to mid-size multifamily investor? And then give that consideration of like a market like a Riverside or San Marco, or maybe the beaches.
Yeah, that's a good question. And that's actually one of the reasons I think, there's opportunities in both ends of the market, but I think one interesting thing about the smaller deals in some of these markets like Riverside and San Marco is that you really have an array of owners buying and selling for multiple different reasons in life. You have people that are purely profit driven, but you also have a lot of owners where it's just simply somebody in their family died and now they're kind of shoring up their estate. Where I think at the larger segment end of the market, it's pretty much either profit driven or it's due to a loan maturity or it's just the end of the deal life cycle in terms of when the equity is supposed to be returned in that sort of, how things are going. So I feel like especially in markets like Riverside or San Marco, those deals tend to really, I don't know that they make a ton of financial sense as much as somebody is just dead set on owning in that particular market because they know that the demographics are great, that there's never going to be any new supply competing with them, in Riverside or San Marco. Granted, pretty much you've got a pretty good barrier to entry because there's just, nobody is going to put new product up that's in directly competing against your product. So I think that is there lies opportunity in that. It's just, as the city gets built up, there will be, more and more 300 unit garden style institutional amenity rich properties. But there's that those properties that are in Riverside and San Marco are going to remain finite, and people want to live in those. People love those properties. And so I think that there's like an intrinsic value in those properties that's interesting. And like I said, they just get bought and sold for many different reasons. In Riverside and San Marco, you can buy a deal where the numbers make sense, even if they're not crazy, but the numbers make sense for you, and you hold it long enough. At some point, you will make a nice spread, because somebody is willing to pay more than maybe it's worth on just strictly an income basis, because there's some sort of emotional tie to those properties, more so than a lot of other areas of town. So I think that is one thing that's very attractive about operating in those areas.
I think another thing about, I live in Riverside right now, and I see a lot of these 2, 3, 4, some slightly larger, like maybe an 8 unit, 12 unit, 22, 24, but smaller multifamily. No one's rebuilding these. So like you might get in at a price that is not a very attractive cap rate, even if you run a 5-year pro forma and you're like, wow, this thing, it just barely debt covers. However, you look at the barrier to entry, the cost to construct, take like a brick quad in Riverside, between the land costs and construction costs for masonry construction, you'd have to do fire suppression now if you built it. So you look at these and you're like, yes, to your point, you take the long view. Now I can bring in somebody who might just want a house hack. So let's say it's, at 4 unit, you have financing. There's actually some other financing that's emerging where you could house hack potentially something slightly bigger. But let's just, for argument's sake, you buy a quad, someone could live in one, rent out the other. Even if they're just going to live for free and self-manage the three units, then you have some flexibility. You might say, well, at this price point, maybe you do go in cash, and maybe the cap rate is so low that it doesn't debt cover, but it's a reasonable return to somebody to just buy cash, where you don't see that happening. And like your 100, 200, 3 unit, I mean, it would just be cost prohibitive. It'd be equity prohibitive to go in there all cash. The other thing that I notice is, that the potential to convert. So like these smaller properties, I'm in a property, I'm sitting right now recording in a property that's zoned CRO, commercial residential office. A lot of Riverside is zoned CRO, and not all the multifamily, but a lot of it. So you look at a property that maybe down the road, it'll be an office. Maybe there'll be like a small, there could be a real estate company in there. There could be somebody living in there and having like a barber shop, or I don't want to quote every use for CRO. But the other thing is you could run like a legal short-term rental, as long as you comply. CRO, you can actually do hospitality properties as well. So you look at the flexibility in Riverside and parts of San Marco for what it could be, versus it really is just an Excel underwriting exercise to go do your 100, 200, 3 unit deal. Your stuff in these little bedroom communities is a little more nuanced. And like you said, your buyer profile, it may just be a higher income, higher net worth professional that wants to have something to diversify outside of their stock portfolio. And the other thing that comes to mind with these properties is, because they're desirable and walkable. Jacksonville is a beautiful city. I love the city, but we only have a few like pedestrian friendly areas. And Riverside, San Marco, Avondale, Murray Hill, parts of Springfield, Beaches, Ortega, parts of it. So there's not a ton of walkability throughout the city. So let's say you want to do like a corporate rental, furnished rental, Airbnb, something in that furnished category. San Marco, Riverside, some of the other areas I mentioned are ripe for it. Somebody could take a plane, take an Uber to the unit, show up with a toothbrush and a suitcase, and essentially treat it like a hospitality property. You just can't replicate that in like your larger 1, 2, 300 unit South Side apartment complexes.
Yeah. No, I completely agree. You can go into these neighborhoods and just look at it and say, this is a great piece of real estate. One thing that sticks out to me that in the first real estate position I had, protect the downside and let the upside take care of itself. And I think that that is what a lot of these deals in the historic districts are. There may be something that happens in the future that allows you to capture this upside that's not readily apparent. And so I think that there's a lot of people that probably have stories about doing deals in Riverside, San Marcos, Springfield, where that happened, where somebody just came along and they were like, hey, I love this building and I want to buy it. And, you're right. You probably see more cash deals, things like that. I would, venture to say that you're probably finding more people paying cash for a lot of these deals in those markets than you are in some of the, other less desirable areas of the city.
And you think about, just to dwell on this Riverside multifamily topic a little longer, I mean, this is an area that you do have quite a few Airbnbs, and maybe the audience doesn't know it, but Airbnb property management, I shouldn't just say Airbnb, short-term rental property management is quite expensive. I'm not going to quote everybody's rates, but if you go out there, it's going to bracket 20%. Someone's probably going to quote you 25. Somebody might quote you 15. I don't think it'll be 10. So I think 20 is, for as far as this conversation goes, 20 is a rate to expect for property management. And you start looking at this and you're like, well, if I pay somebody 20% property management, and that doesn't include my housekeeper, I still have to pay my housekeeper and all of my property expenses. That's right off the top. So, I'm wondering, are you seeing your sellers try to bridge this gap from, I'm sorry, your buyers? Are your buyers bridging this gap with the seller expectation being kind of this 2021 type pricing where you had 3% debt, all the rents were just double digit growth, everything looked so good? Are you seeing buyers try to bridge those pricing gaps by changing their model and running it as an Airbnb or a corporate rental?
I think they were. It's interesting you say this because I've heard this feedback from several of my contacts that do short-term rentals or corporate rentals. So it's interesting because probably about 4 years ago, around COVID or before COVID, they're just, that wasn't nearly as popular, corporate rentals and short-term rentals. I think people realized early on that there was a nice spread there to make a nice, where they would look at a deal and say, hey, I can make this much as a long-term rental, but look at what I can make as a short-term, especially if it's well located in the neighborhoods we were just discussing. But I think what happened over the last few years is those markets started to get saturated because every person realized there was a little bit more money to make if they could do something creative with a short-term rental or a furnished rental. And so a lot of those started coming up. I remember seeing them. If I was looking at Brent comps, I'd be clicking around and I'd see a lot of descriptions that said, offered as a short-term rental, internet include, all this stuff included. And I could tell anecdotally that a lot of people were starting to do that. But what I've heard and what I've seen is that people who picked good locations to do that, whether it be at the beach or Riverside or San Marco, I think still can find success doing those strategies. But what I think that people, the people that I think that are not going to do well or are having disposing of assets they bought now were people who maybe bought in areas that were just kind of mediocre and really didn't make sense for a short term, an area that wouldn't have a hotel. And so because it didn't have a hotel, it's probably the reason, there wasn't demand there to begin with for short-term housing like that. And so I think that there were probably a lot of purchases by people of buying in areas that were just kind of not really meant for that. And now they're either having to convert it back to a long-term rental, or they're just selling the property, putting it back on the market, hoping to sell it to an owner occupant or something like that. So do think that was very popular for a period of time, but I just think that it's a real kind of situational thing right now, where if you bought at the beach east of 3rd Street or something like that, you're still doing fine with short-term rentals. But if you bought in I don't know, somewhere on the west side in just a residential neighborhood or something like that, there's really nothing to draw you there. I think that that's probably not doing nearly as well. So I have seen that, change. But I do think that, when the property makes sense, when it's in an area that makes sense, I do think it's a great strategy if that's the kind of business that you want to go in. It's just obviously much different because it's much more operationally intensive than long-term rental, and there's financing things and insurance things that go into that as well. But certainly I think if the area makes sense, then I think it's a great strategy still.
Yeah, one strategy that I personally like with using Airbnb as an investor is I'll use it in conjunction with a house hack. And for those that don't know that term, that's where you actually rent out a part of your homestead property, your primary residence. And you can actually do it in a single family, but most people would house hack like in a small multifamily 2, 3, 4 unit property. So I tend to buy or live in houses that have a rental component, but you do have to be careful. Disclaimer, most people are just listening, not watching. I was waving my hands. You want to watch out and make sure you don't violate any homestead regulations, but you can do that by essentially like the duration and amount of rental. So one thing I like to do is have a small space, because bear in mind, these are short term. You can get away with, by example, the one in my home, 200 feet. It's actually like 190 square feet. So very small. It'd be small even if it was a hotel room, and it has a kitchenette, and it has a full bathroom, Murphy bed, exposed brick walls. You can walk everywhere. You can walk to 5 points. It does pretty well for 180 something, 190 square feet. It may do 60, 65% occupancy, and we never go under $100 a night. So you can kind of back into the numbers there. It should do over $2,000 a month. I don't even notice it in the utility bill. It has separate entrance. And so consider if I was going to do something with that space in a traditional or long-term format, I'm not even sure if I could rent it out. It's so small. And if I did, even in Riverside, which is a good rental market, not furnished, I mean, I'm going to take a stab at it, maybe $700, maybe. I mean, it's just too small. I don't have laundry in there. I don't have a full kitchen in there. Certainly under 1,000. And here I am, Florida, Georgia was not long before this recording. We had $720 for 2 nights for Florida, Georgia. Now that's Florida, Georgia. It's an outlier, but you can take advantage of some of these very high value moments as a short-term operator, and still maybe keep your property vacant or have family in there. Be careful with your homestead and things like that. But it is a way to, in my opinion, it's a great tool to get high revenue from small spaces versus when you have a traditional rental, unfurnished. A lot of people are going to be looking at like the price per square foot per month for this residential rental. Not everybody thinks that way, but appraisers and brokers and lenders do. And you really can't get away with such a small space on these longer term, but you put together a cool, eclectic, cute spot in a highly pedestrian area, you can make pretty good money. And so the way that I've used that is just to buy better real estate that I'm going to personally occupy, and I'm going to offset holding costs. And whether it's at the beach or Riverside or some of these high barrier to entry markets, you can get a better home for yourself, rent out a small portion of it, and do pretty well. It's one of the ways I like to use short-term rentals.
Yeah, no, I think that's a great strategy. I think anybody, starting off or who is comfortable doing something like that. And the funny thing about that too is that what you're describing, a lot of times the properties with these sort of like in-laws, or garage apartment, these separate dwellings are actually some of the nicest neighborhoods in the city, that have those. At the beach, that's common. In Riverside, that's common. So it's kind of funny because not only is it a good strategy, it could help you get into an area that is honestly like some of the best real estate in the city that happens to have those unique opportunities. So I think it's interesting.
And Stephen, in this world of small multifamily, and we can go up in the unit count, I had an 8, a 28, had a little 3 unit, and then we started to do some bigger projects, 83 units. And what I found is it's a very different game. Do a lot of your clients kind of stop at a certain point? Are like, oh, find me an 8 unit, find me a 12, a 16, a 24. Where in your opinion, because this small to mid-sized multifamily, I'm going to state a few things that are obvious to me, but maybe not obvious to the audience. Your lending oftentimes changes. Your underwriting and expense ratios may change for smaller multifamily. Your CapEx per unit can change because you don't necessarily have the economies of scale. You do have people that may try to self-manage because it's a lower unit count. So you have these variables. Kind of where do a lot of your clients fall that are, I know we mentioned the people buying quads in Riverside, but let's upgrade a little bit, how the buyer profile shifts a little bit as you move up this multifamily ladder, but stay, well under 100.
Yeah, no, that's a good point. I think that the smaller buyer, or I should smaller buyers, people buying stuff in smaller deals in Riverside and the historic districts, things like that. Those are typically sometimes local investors with their own money. Sometimes they're out of state investors with their own money. You're typically not finding people raising money for those smaller deals, and you're right. They're managing. They're managing with third party, or if they're local, they're managing themselves. So I think that those properties are interesting because when I'm working on a deal that is smaller like that, honestly, people hate to hear this, but the underwriting when you're valuing it is almost irrelevant because everyone is going to operate. The only thing that's going to stay the same are the real estate taxes. I mean, I should say the same. The only thing that is going to be the same regardless of how somebody's operating it is that the real estate taxes are going to reassess. The insurance is going to be new for a new buyer. The utilities are likely going to stay the same, but all the repairs and maintenance, it's going to vary so much depending on who and how they're operating that property. The management fee is going to be what their particular management company is going to use. So all of that stuff changes so much for a buyer on the small end, just depending on who they are. Is it a guy that just has a handyman and he likes to be hands-on and he likes to be in there doing that kind of stuff? Is it a guy that lives in New York and he's going to hire a third party and he's going to be very passive and just that's the way he's going to manage it. And then you go up in size a little bit, and then those deals, those 40, 60, 80 unit deals, that's kind of an interesting space because that's where you get people that are starting to raise money for deals. They're typically going to usually be ran by third party management. Usually at that size, I feel like you don't have a lot of groups that are vertically integrated and kind of managing that on their own. It does tend to be third party mostly, but it's just a very different nature of owner investor. And I will say that some people, after they do their first few smaller deals, their whole goal was they use that as a stepping stone into getting into larger deals, and that's been a goal of theirs all along. And they want to go out and they want to raise money and they want to build a business that way. And then some, there's the keep it small and own it all strategy. That we have friends that have done that, ourselves, and done very well with that. I don't think there is a right or wrong solution. I've seen people that have done very well in both arenas, whether they're they're trying to grow and grow their unit count and the deals they want to do, or they just want to find a couple of smaller deals a year with a really nice spread and do it themselves. So yeah, there's a lot of different things when it comes to the capital raising component, the operations component, financing, and I really don't think there's a right or wrong, but there's definitely pros and cons to both. Definitely seems to be in the smaller deals, I guess there's more opportunity sometimes in finding a price discrepancy and things like that. Obviously it's easy to generally raise the capital or have your own capital for deals that size. The larger deals obviously provide scale, which is nice. That's, scale, I feel like, is one of those things you really don't, internalize it until you feel it. And it's just challenging to do some of these deals. And you realize like why people preach scale over and over and over again, because you end up doing a lot of things on these deals that are really challenging, and it's the same amount of work whether you're doing a 40 unit deal or a 60 unit deal. But I don't know if that answered your question. I don't know if I touched on a couple of things or not.
No, you did. You touched on you touched on a few things, and I have a couple of thoughts on it as well. I did personally really well with smaller, mid to small multifamily, but I haven't done one of those in a little while. And you are right. I mean, like you can go far by owning it all. I will say, as I sit here right now, most people probably fall into two buckets. Like, are you trying to be an active investor in commercial or multifamily? I mean, do you want to be underwriting deals? Do you want to be possibly asset managing and or property managing? If do you want to go all the way to the level of like personally renovating units? That's a very different person, different investor, different avatar versus, person B or this other bucket, a higher net worth individual. Maybe they're IT or medicine or law or whatever it is, but they have something they can do every day that has like a high hourly correlation to their time. In my opinion, unless they just desire to jump over and be this active investor, they're probably better suited for the large scale multifamily that does have scale, has economies of scale and operation, and that is open generally to limited partner investors. And they're probably accredited so that they can go ahead and enter these deals and be insulated from downside beyond just the loss of the capital invested. So those are very different people. I think if you're trying to really move the needle rapidly, that active investor bucket, which is really where I have been most of my adult life, has been really good to me. But it is a lot of work. It's a lot more than people think. This more like LP passive busy professional bucket, a larger deal with a good operator. And it probably doesn't have this like hockey stick upside. It's probably a little bit more predictable. That's a good place to potentially park your money. I'm going to pivot a little bit on you, Stephen. I know everyone loves predictive questions, but we're at this kind of stalemate. At least the transactions would indicate we're at a little bit of a stalemate in the transactional economy. What's nice, in my opinion, is if you're an owner, at least in Jacksonville, your pricing's okay. I mean, rents are stable, like you said. In certain submarkets, you might see a very small slide in multifamily rents, but they're more or less stable. Everything's pretty much full. So the obvious challenge that everybody knows listening right now, interest rates. You have a doubling of rates, and it's just how can I hit a 1.25 debt coverage? I can't push the rents anymore. People are a little like blind about the true capex. And so you start to put all these things together. You're like, I can't transact right now. But let's take kind of a dual track look. How do you see like the next 100 days kind of take us through Christmas into the first quarter? Maybe it's just more of the same. I'm just curious if you see anything. And then kind of where do you see maybe a year from now, maybe a year to 18 months? So kind of like the most immediate 90 to 100 days, and then kind of a little bit longer view at like, say, 18 months.
Yeah. Well, say for the next 90 days, I mean, my experience has been over the past few years since I got into brokerage, the holidays slow down. I mean, we're right before, about 10 days before Thanksgiving now, give or take, while we're recording this. And historically, this is when it's interesting. There's a bifurcation of the market right now where you have, I would say the majority of the people saying, hey, if I wasn't, going to, if I don't have anything teed up now, if I don't have anything interesting in front of me, if I don't have any compelling reason to do something, it's pencils down and I'm going to travel, spend time with my family, start preparing for next year. A lot of people in our business use December as sort of that like game planning strategy time. And so I think that there's a lot of people out there that if they were already inactive, they're definitely not doing anything now. They're just done. And I think there's a very small subset of people around this time that usually actually this is when they decide, hey, either whether it's for tax reasons or something interesting, I'm really going to, I'm deciding that now is the time when I'm going to make a move. I'm going to fire sale that property, or I've got a large capital gain. If something comes out that even looks halfway interesting, I'm going to jump on it because I want to pick up that depreciation. I'm going to do a cost segregation study, and I'm going to wipe out those gains from earlier in the year. So I think that you'll have some people doing that, but it's still challenging to put a deal together right now with rates being where they are. So I think that you'll still over the next 30 days still see very low transaction volume, and And I think you'll see a few things that'll happen like they always do end of year, where it's just like, man, they, something goes on the market, gets snapped up, and there's some sort of tax reason or something that was, interesting about a deal just kind of coming together really quickly. So that's my thoughts for the near term. I think that just due to the holidays and due to the capital markets being where they are, probably still pretty pretty slow. I think a year out from now, though, I think we're finally, people have used analogy of kind of like that like cruise ship slowly moving into like a like a wall, where you could see those maturities coming. You knew that people were going to have to make a decision. I think that we're finally getting to that point where, you can see, I have software where I can run maturities, and I can see what somebody paid for it, can see what type of loan they have. And I can see, hey, this person's got to make a tough decision, like it's coming to a head. So I think that we're going to start seeing some more of those in 2024, where this distress that people knew was coming for a long time is going to start to be a catalyst for some decision making. I think there's a lot of owners out there that are still in good shape. They have fixed rate long-term debt, and they're in, they're not going to have to do anything, and they're just kind of waiting and not really doing much. But I do think that we're finally coming to a period where there's going to have to be some tough decisions to be made. I'm sure you've already seen the headlines that across the Southwest and Southeast, there have already been some groups in trouble doing loan workouts and different things. But I think that we're going to see more of that. And so, definitely, I think that's going to be, something that we see in the market. But I think you'll see transaction activity starting to pick up in the second half of next year. I think just because I think that I personally feel, I can't, we'll probably look back at this maybe and laugh. I know I have done on previous podcasts where I made predictions, but I at least think we're to a point of sort of plateauing in terms of where rates are going. I think that, they're at least going to just stay flat and stabilize. I don't really see them going too much higher, but I also unfortunately don't see them going really low in the near term. But I think that the second half of next year, we could see a little bit of relief. And I think that people, once they know that the increases are behind us and everything, that we start seeing some deal making. The only thing I will say is that, if we do see some economic distress in 2024, that'll obviously be interesting because, we might see rates finally stabilize. But, if unemployment starts ticking up and people start pulling back on spending and things like that, that'll be interesting. So anyway, but yeah, I think so. That's my short answer. Nothing in the near term, but I think that the second half of next year, I think we'll start seeing you'll start seeing some transactions from people that have to make decisions.
Yeah, and I tend to echo your sentiment. I do think that it's the bigger to be determined is like go forward a year or a year and a half. Let's say rates are slightly lower, just enough to get people slightly excited. Let's say maybe they come down a point, just spitballing with you. Is that enough, to get people excited again, to have sellers maybe ratcheted some expectations down? And then what's interesting is, to your point, where's employment? Because I was appraising through the downturn, like I was appraising in those really tough years. 9, 10, 11, 12, all the bad news years. And we were back then bleeding like 500,000 jobs a month. We're nowhere. That's not even close to our reality now. Now it's more just like frozen economy, like the seller strike some people talk about, where like you have sellers sitting on great debt. Not all of them. Some of them are ballooning, but those that are sitting on great debt, not motivated to do anything. So then you wonder, is it like a global conflict? Is it a war? Is it rates? Is it employment? And then what we don't know, because it's just starting to happen, how are lenders going to treat these maturing loans? Or maybe they're not maturing. Maybe they're just coming off of, maybe they're like resetting, or a rate cap issue, or like an imminent default, but the property's still doing fine. So what I'm curious to see is, do they want to modify, work out, and restructure? The last time we saw much of this, banks took a lot of property back. That didn't go very well. These properties were sold at, pennies on the dollar a lot of times. And so I'm kind of curious to see if there's a posture of working out more loans. If COVID's kind of a weird, well, more than a weird anomaly, but if you look at how lenders treated COVID, it was seen as temporary. There's forgiveness, forbearance, stimulus. A lot of this is federal. But my point is, I'm curious, like on the banking side, will there be relief in the future? Are they going to work out these loans, or are you just going to have maturities and defaults and dead fish floating up and more bankruptcies? It's probably somewhere in between. I think that my personal opinion. I think that those, and we are recording this is the Jacksonville commercial real estate show. I can't speak for all corners of the world, but in Northeast Florida, I don't think we're going to have a lot of dead fish floating up. I think those that aren't taking any action, they're just not going to be transacting for a couple of years. And we'll see stuff in like the Business Journal and the Daily Record about these deals that somebody got. And we're like, oh my God, how do you do that? Those are the ones we've been waiting for. I just don't think it's going to be to the scope and scale that a lot of people believe. So if you can find a way to transact, if you could take advantage of like loan assumptions or seller financing or some creativity right now and still have some transactions under your belt, I personally think be cautious, be shrewd, but I do think that's a better approach. I'm going to pivot on you, Stephen. We have a local deal breakdown. I only ask this of investor guests, and you qualify because you are a multifamily broker, but you also invest, and you have a local deal we can break down. So the categories are: what and where was it? How'd you find it? How'd you fund it? What was the opportunity? How'd you exit? And lesson takeaway. So don't worry, I'll do it all again. But step one, what was it and where was it?
It was an 8-unit property in Avondale in the Riverside area.
Wonderful. 8-unit in Avondale. How'd you find it?
A broker had it, a newer broker had it with probably a not so long buyer list, had it off market and shared it with me because he was new to the business. So
off market, maybe a younger broker. How did you fund it?
A local credit union.
Local credit union. I will say, not to derail you, ViStar, I'll give them a little shout right now. They funded my 8-unit and my 28-unit back in.
It was ViStar. Yeah, ViStar on this one. Yep.
I don't mind plugging the locals that are doing a good job for us. So good. Local credit union, ViStar. Did you have to raise equity, or did the partners just shoulder to shoulder?
No, it was 50-50 with my old partner. Yeah.
Wonderful. What was the problem and or opportunity, and how did you fix it?
This was a local owner that was very affluent, and this was it was one of those great properties where they were sort of friends with the tenants, and so that the rents were very low compared to market. However, they treated the building extremely well in terms of just keeping up with the maintenance and everything. So it was one of those great opportunities where, from a physical standpoint, it was an excellent condition, but from operationally, in terms of where the property could have been performing, there's a lot of low-hanging fruit to grab and just bringing the rents up.
All right, so it sounds like the physical plant, as we said in appraisal, the property itself was in good condition. What did you have to do to reposition? Was it a managerial value add?
Yeah, that's exactly it. We didn't really do anything substantial with the renovations. The units were sort of in a classic, kind of historic property condition that I think some of the tenants actually liked. I think there was and we also saw that too. I think the play was, hey, we'll go in, bring the rents up. However, we can sell this as a value add to that next buyer who does have ambitious plans, maybe to go in and turn this. It was a beautiful building. The exterior really stood out. The interiors had really nice high ceilings, hardwood floors, but I think that somebody could have went in and done something else with the kitchens and the bathrooms. And so that was sort of the play. Hey, we'll go in, bring up the rents, and we'll kind of position this later to sell as a value add deal to somebody who does want to really do that. I'm not really a construction guy or design guy. That's not my my area of expertise. I would bring on a partner who was good with that stuff. But anyway, we we just left the physical condition of the property how it was.
And how did you exit? Was it an exit or a hold?
So we did exit the property. So we a buyer who was looking for a 1031 exchange, specifically in Avondale. I thought that would be the perfect deal for them. Ended up not working out with that buyer, but the lender, and this is one of those weird things about real estate, the lender who was working on it was actually an agent himself. He was a mortgage broker and an agent. And I said, hey, listen, unfortunately the deal fell through. But if you've got anybody you think would be a good fit, let me know. And he did. And they were, a great buyer, and they ended up, doing the deal relatively a similar pricing to what the original deal that we had teed up was. So it's kind of one of those things that just happened very organically, and we felt like we got a pretty good number for where the rents were. So we decided ultimately to sell.
And what was your lesson or takeaway on that deal?
Number one is what I said in the beginning of the podcast, protect the downside, let the upside take care of itself, I think is a great mindset to go into a real estate deal. I think if you know what the downsides are, but you can put yourself in a position to get lucky at some point during your whole period, whether that's taking advantage of a advantageous capital markets by refinancing, or a 1031 buyer coming on or something like that. But that you can kind of hold for a period of time that will allow that sort of luck to happen. I think that's probably the number one lesson. But also too, I think one thing that I'll say is don't underestimate when you're buying these historic properties. It's not like buying a brand new construction property. You should estimate that you're going to likely have higher capex costs and repairs and maintenance than you would for a newer property. They're older. You're buying a 100-year-old property. You have to know that inevitably you're going to have plumbing issues here and there, unless the plumbing's all been, completely redone. You're going to have maybe some structural issues. It's not a reason not to buy the property, but it's just something that you need to not fool yourself that those things are inevitably going to, present themselves, and you need to be prepared for them.
I'm sitting in a 105-year-old dwelling in Riverside, so I could not agree more. All right. We're going to dive into our closing questions, and they are very Jacksonville. You ready?
So
All right. What is your favorite local restaurant?
my favorite local restaurant is a newer establishment. I think it's been open for about a year, Bar Molino in San Marco. It's a tapas spot, and I'll be honest, had low expectations going in, because I didn't know if somebody was going to do that well, and they just knocked it out of the park. It's incredible. I love it. If I didn't live at the beach, I'd probably go there much more often, but a great little spot in San Marco, really well done.
All right. Bar Molino, San Marco. Next question, a local business that people should know more about.
Well, I am a big foodie guy, so I will throw out another spot that I really enjoy, Mesa, and it's a great little spot over in the I guess it's close to Riverside. I guess you would call that area Fairfax, I believe.
Yeah.
But it's kind of hidden. It's funny because it's a spot where it's one of those cursed locations where I think several restaurant concepts failed there over the past 20 years or so. And it's kind of like an Indian fusion spot, but the food is incredible. It's definitely tucked away. You wouldn't know about it unless you heard about it from a local. But if you're into Indian food at all, it's their kind of spin on it, and it's really incredible.
I could not agree more. I have not been to Bar Molino, but I just went to Mesa within a week of this recording for my wife's birthday. Tasting menu, like 5 or 6 courses, unbelievable. One of the few meals that, looking back months later, I still think about. So I'm going to go ahead and give them a full big Yield Coach endorsement there. And it's adjacent to the fire department. So you get a little action next door, and we sat outside. Great environment. All right. Local hidden gem that the audience should know about in Jacksonville.
So I think a good, and this one I'll bring it back. The other ones I did are in Riverside and San Marco, so I'll take it out to the beach where I am. Is Colhane's, a great Irish pub, great food, great vibe. They've got karaoke and trivia and all kinds of stuff, but it feels, you go into it and it's in kind of like a little strip shopping center. And so, but when you go inside, I mean, it's really, you're kind of transported. It feels like you're in more of an authentic Irish pub, and just really some great food and great times there. So that's my hidden gem.
All right, Cole Haynes in Atlantic Beach. I like it. All right. Well, we're always looking for the next interesting guest. You've been great, Stephen. Who's someone that you think is making moves in Jacksonville that the audience would benefit from getting to know?
So I just had lunch with a guy I've been meaning to connect with for at least a year now. Andrew from Joseph Ellen Properties had an interesting story. He moved here from St. Louis, I think 3 or 4 years ago. He started a short-term rental third-party management company, owns a few deals himself, and also is potentially exploring getting into the long-term management space. But really enjoyed lunch with him, had a lot of insight into the short-term market. Really seems like a operator who's got a handle on things, and is growing rapidly, and kind of like looked to as a really a sort of a guy in that space that knows the numbers, knows the market. And I would say anybody that is in Jacksonville looking, either operating in the short-term rental space or looking to get into it, he's a great resource.
Awesome. All right, Andrew at Joseph Allen Properties. Sammy, our producer, might be reaching out to you soon. All right, Stephen, this has been awesome. Where can people find you and learn more about you?
I think pretty easy to find. Just Google my name. You can find me on LinkedIn, Franklin Street website. You can see any of the deals I have out, but shouldn't be too difficult to find. So shoot me a message on LinkedIn, or find my contact information on Franklin Street website. If you're interested in multifamily deals in Northeast Florida, if buying, selling, or just curious about the market, always happy to hop on a call and talk through it. And if you're just anywhere else in the region and ever stopping through Jacksonville and want to talk multifamily, I'd love that too.
Awesome. All right. Stephen McAdoo, Franklin Street Director of Multifamily. It has been a pleasure. All right, everybody. If you enjoyed this, please do us a favor and rate and review the podcast. Share it with a friend. Makes a huge difference. Helps us continue to bring you great guests like Stephen and better content. As I mentioned earlier, to stay up to date and never miss an investment opportunity, go to investwiththecoach.com, answer a couple questions, and join the team. If you're into socials, we are Yield Coach on Instagram, Facebook, LinkedIn, and YouTube. We're not on Twitter, but we're on the rest. And we frequently post deal opportunities and inside looks. That is a wrap on this Jacksonville Commercial Real Estate Show. I'm your host, Ian Brown, signing off and reminding everybody to lace up and leave it all on the field. Yield Coach out.